Okay, let's dive right into this. Welcome to today's Explainer. We're breaking down a massive, rapid-fire stock analysis of a tech company that literally just hit a major inflection point. Is nLIGHT a buy, or should you bail? Let's get right to the numbers. So who exactly is nLIGHT? Trading under the ticker symbol LASR, they're a premier hardware manufacturer of high-power semiconductor and fiber lasers. And to put that into perspective, we aren't talking about everyday laser pointers here. We're talking industrial-grade optical power, the kind originally used for cutting thick steel, advanced welding, the whole shebang. But right now, the company is in the middle of a tough yet potentially incredibly lucrative strategic pivot. They're making the hard jump away from commoditized industrial cutting equipment and moving directly into high-margin, mission-critical aerospace and defense systems. Management is deliberately phasing out their low-margin industrial markets. Now, that actually creates a massive $25 to $30 million revenue headwind for them in 2026. But they're doing this to shift into a pure-play aerospace and defense model. Specifically, they're building next-generation directed energy weapons, or DEWs, for the U.S. Department of Defense. You might be wondering, why are directed energy weapons suddenly such a big deal? Well, think about modern warfare. Right now, militaries are being forced to shoot down, say, a $2,000 rogue drone using traditional interceptor missiles that cost upwards of $2 million a pop. It's just an unsustainable economic equation, right? Lasers, on the other hand, cost literally dollars per shot. That's exactly why nLIGHT's technology is getting integrated into major national security infrastructure, like the Joint Laser Weapon System and HELSI-2 programs. And this is absolutely crucial, because breaking into closed-door DoD contracts is incredibly difficult for a commercial company. But once their vertically integrated tech gets designed in, the switching costs for the government are astronomically high. Plus, nLIGHT is actively moving their geographic footprint away from China, leaning heavily into North America and Europe to secure those sensitive supply chains. Now, what's really interesting about this competitive dynamic is the whole David versus Goliath narrative we've got unfolding here. They're operating in a highly concentrated oligolistic market. IPG Photonics, sitting at a $12.5 billion market cap, absolutely dominates the industrial space. But IPG is built for massive industrial volume. nLIGHT, on the other hand, is outmaneuvering them through sheer agility, winning these bespoke, ruggedized U.S. defense contracts that require highly specific engineering. Then you have Coherent and Luminum, both massive entities for sure, but their broader portfolios skew heavily towards standard materials or telecom infrastructure rather than pure-play, high-power defense systems. So nLIGHT is carving out a very specific, highly lucrative, and heavily defended niche. And all of this strategic maneuvering leads us right to this exact moment, Q2 2026. This was the inflection point. Let's look at the blowout financial results that recently hit the wire, because this quarter was essentially the ultimate proof of concept for their incredibly risky pivot. 33.8%. That is their year-over-year revenue explosion for the second quarter, hitting a record $82.6 million. To contextualize this a bit, seeing nearly 34% top-line growth is common if you're a software company pushing code, but it is incredibly rare for a hardware manufacturer that actually has to build physical factories and manage tangible supply lines. And what drove this? A massive 41% surge just from aerospace and defense alone. The pivot is undeniably working. Which naturally leads to this number, 32.6% non-GAAP gross margin. Wall Street cares deeply about this specific metric, and here's why. It proves that the core underlying business is actually profitable once the transition dust settles. By exiting that low-margin welding business we talked about a minute ago, they've structurally repaired their profitability. This margin expansion allowed them to post an adjusted earnings per share of 15 cents, absolutely crushing the 11-cent consensus expectation. And that translates directly to $21 million in record operating cash flow. So the crucial point is that this shows phenomenal cash conversion efficiency. In the world of defense contracting, turning government IOUs and massive backlogs into actual cash in the bank is notoriously difficult. Generating $21 million in hard cash proves their operations are completely dialed in. In fact, they generated nearly $10 million in non-GAAP net income this quarter, completely reversing a loss from a year earlier. But here is where the story takes a very sharp turn. Imagine the whiplash investors felt. We have a massive Q2 beat with a 91% year-over-year surge in adjusted EBITDA. And the market's response? The stock crashed roughly 15% after hours, plunging from over $75 down to $64.25. It's a massive disconnect, and we really need to unpack what happened. The immediate trigger for that crash was management's weak Q3 guidance. Management's exact words cited a sudden supply chain disruption tied to China scrutiny. And honestly, this is the Achilles heel of modern U.S. defense technology. Let's take a second to understand this. You can design the most advanced directed energy weapon in the world, but if you can't source the rare earth minerals like neodymium or the highly specialized optical glass required for the laser core, you simply cannot ship the product. These base materials are heavily bottlenecked by China, and this single point of failure represents a sudden geopolitical sourcing fragility that caught investors completely off guard. That specific geopolitical disruption immediately deferred $17 million in product revenue out of the near term and pushed it into future quarters. This perfectly illustrates the current reality we're dealing with. While the demand for these weapons is practically infinite right now, supply constraints and international trade tensions are very real execution risks. Wall Street hates uncertainty, right? Especially when a company's timeline is dictated by geopolitical forces entirely outside of its control. That's exactly why the market aggressively repriced that risk overnight. But before panic sets in, let's take a look at their financial armor. nLIGHT possesses a fortress balance sheet. They're sitting on roughly $330 million in cash reserves. That's $5.19 purely in cash per share. Their total debt is negligible, just under $15 million. Furthermore, their current ratio is massive at 8.17, meaning they have over 8 times the cash on hand needed to cover their immediate short-term liabilities. They literally have zero short-term liquidity risk. And you really have to give management some credit here. A lot of this cash came from a $350 million public offering executed at peak stock prices earlier in February 2026. They raised cash while the sun was shining, meaning they can easily survive this supply chain shock without diluting current shareholders. And this brilliantly illustrates who exactly is holding those shares. Institutional ownership is effectively at 100% of the outstanding float. 642 institutions hold roughly 66.4 million shares. That is heavy smart money backing, which is a fantastic vote of confidence. But you also have to realize the severe illiquidity risk here. When 100% of the float is owned by institutions, it's like being in a crowded theater with a very small exit door. If all those funds decide to sell on bad news, at the exact same time, there are basically no retail buyers waiting to catch the falling knife. And that is exactly why the stock cratered so violently on the Q3 guidance warning. We also have to track what the insiders are doing. In late May 2026, CEO Scott Keeney sold over 82,000 shares in the $77 to $81 range. Now, to be fair, some of this was via pre-planned 10b5-1 programs. If you aren't familiar, a 10b5-1 is a pre-scheduled automated selling plan designed specifically to avoid insider trading accusations, making this fairly standard executive compensation behavior. But still, it also signals that leadership recognized the stock was fully valued when it crossed above that $80 mark. Which brings us directly to the valuation risk. At a market cap of over $4 billion, nLIGHT is priced for absolute hypergrowth. It's trading at an enterprise value to sales multiple of roughly 11.5, and the forward price to earnings ratio is north of 100. When a forward PE is that high, you are paying a massive premium for future profits. With multiples this astronomically high, the stock's premium requires flawless execution. This creates what we call multiple compression. When a stock is priced for perfection, even a minor delay, like, say, a $17 million revenue pushout, acts like a pin popping a balloon, causing the valuation multiple to shrink rapidly. So what is the actual fair value? Based on the analysis, here are the 3 scenarios. The bull case sits at $90. This happens if the supply chain delay gets resolved quickly and the Joint Laser Weapon System ramps flawlessly into 2027. The base case, hovering around $70, assumes steady growth but with lingering supply issues through the second half of 2026. But let's look at the mechanics of the bear case, down at $45. This factors in the very real risk of U.S. defense budget cuts. If Congress hits a gridlock, relies on continuing resolutions, or initiates sequestration, defense spending gets frozen. Combine that with structural margin degradation from Chinese supply chain restrictions, and that $45 level becomes a very real possibility. Right now, sitting at $64, the margin of safety is definitely low. Now let's demystify the technical picture. The stock had a massive upward trajectory from late 2024 through mid-2026, but that sudden August drop we just discussed, that broke the immediate bullish momentum. There are heavy institutional support zones between $55 and $60, right around the 200-day moving average, which often acts as a psychological floor for institutional buyers. On the upside, that $75 area where the stock fell from is now hard resistance, and the weekly RSI, which is really just a momentum indicator, has cooled off from being heavily overbought down to a neutral 50, meaning the hype has officially left the building. The chart has definitely hit a wall in the near term.
Let's move to the endgame and see how this all builds into a final actionable strategy. The investment verdict from the research is pretty clear. Hold for existing investors and wait for a dip for new money. The ideal entry or accumulation zone is lower, somewhere between $55 and $60. Because this is a high beta defense technology play, meaning it's highly volatile compared to the broader market, your position sizing should be a maximum of 2 to 3% of your portfolio. And the strategy? Dollar cost average. Buy in small chunks over time. Do not lump sum your investment at these current valuations. Averaging in protects you against further unexpected geopolitical supply chain shocks. Just wait for the multiples to cool down a bit. So, we leave you today with one final question. Is the practically infinite demand for next-gen directed energy weapons worth the fragile reality of our global supply chains? nLIGHT has successfully executed one of the hardest maneuvers in hardware by pivoting to defense, and their fortress balance sheet guarantees their survival. But as this week clearly showed us, execution risk is ever present. Thanks for joining us to break down the numbers, and we'll catch you on the next explainer.